Monday morning from Hong Kong, half an hour away from the opening bell here in the city, in Shanghai and also in Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: onshore Chinese stocks and the yuan set for gains as traders return from the holiday, helped by Beijing's supportive policy stance.
President Xi Jinping touching down in Paris to begin a three-nation European tour aiming to boost ties even as trade tensions continue to rise.
And I'm Stephen Engel, live at the BNP Paribas Global EV and Mobility Conference here in Hong Kong, where leading industry players and analysts are discussing the future of electric vehicles.
And I'm sure Evie is going to make it to the discussion here when she steps down in Europe here. So certainly that's going to be a key discussion throughout the next few days or so. But markets-wise, you're actually seeing this price action quite favorable towards risk assets here this morning. You got to thank that U.S. job support, where we finally saw some signs of cooling in the labor market that really helped send risk assets higher. You take a look at how bond futures are still trading here in the U.S. Mind you, Japan still closed today. We're slightly lower here this morning, but we saw basically Treasuries surge, especially in that two-year yield. We basically went from 5%, which was a 2024 high just earlier last week, to about 4.7%. So a 30 basis point drop of late. You're seeing that basically across some of the Asia sovereign bonds here this morning. Aussie 3-year yield, as well as the Aussie 10-year, is slightly catching a bid here this morning. And we're watching very closely what happens with dollar yen. We heard from Yellen talking about maybe a rumor that yen intervened, but still had some pretty harsh words when it comes to intervention as well. We're still trading around 153.42 here, but certainly the drop in the dollar post NFP, that certainly is helping Asia here this morning. We're also watching Hanhai. There you go, at the Taiwan Open. April sales was pretty good. We're up about 19% here, and they said it was basically climbing to a record when it comes to revenue. So that helps in terms of the Apple story potentially as well. Brent, we're watching very closely. A little bit of a premium here this morning. You talk about what's been going on over the weekend. There was some of these, I guess the border in Gaza has been shut, the humanitarian crossing. There was also a rocket barrage that was fired by Hamas. So that really puts a lot of these weeks-long negotiations for a ceasefire under jeopardy here right now. So we're watching, of course, the geopolitics. We talked about the dollar has been pretty flat. U.S. futures also here this morning. But really, we're really counting down to this China reopen here today, right? So given just how stellar Hong Kong was just last week, there is plenty of room, it seems, for catch-up. Mind you, they've been shut for 3 days. Hang Seng gained some 4%, 8 shares as well. Nasdaq Gold Dragon was surging as well all week. So basically, some of these ETF trackers are definitely showing how much room we could see in terms of positive gains here this morning. The renminbi as well. We had the best week of the year when it comes to the offshore rate. We're hovering around that 720 level, but maybe we could see a bit more catch up and bridging that gap between the onshore and offshore here today. Futures are pointing positive. Dave?
Yeah, we will likely see, Yvonne, to your point there, the onshore rate jump. I mean, we closed at 724 or north of that, of course, before we went into this sort of 5-day hiatus here. So we'll see that updates in about 27 minutes from now, and certainly what we'll get as far as the anchoring or the lack of it at this point in time is concerned. We'll dig deeper into President Xi Jinping's trip, of course, in Europe. Touching down, of course, in Paris. The stock rally in Hong Kong, just to give you a number, we're 9 straight days now on the Hang Seng Index benchmark. And to Yvonne's earlier point, 3-4% was the move in the CSI 300 ETF, at least one of the ones that tracked the CSI 300 in the U.S. Since the mainland went into the long holiday. A couple of PMIs are coming out this hour as well, and not also to mention Hong Kong PMI was actually out about 30 minutes back, 50.6. Was the level to watch there. But yeah, we're looking ahead to the reopen today. Plenty of catch up to do.
And what have they missed in the last 3 days, right? So it's not just what we've seen in Hong Kong. There was this, the positive tones coming through from that Politburo meeting on housing supply and the like. You also have, of course, this better than or worse than expected job support out of the U.S. So there's plenty of tailwinds, I think, today, too.
Yeah, you're right. So the Politburo, the details of that came out Tuesday evening. And of course, that was Tuesday was when this market last closed. A lot of the details you see on your screens right now, and by the way, right, so many of the analysts we've spoken to since that point in time last week have flagged better macro data, a more supportive regulatory regime as it pertains to the capital market, a sort of 9-point plan, and perhaps stronger signaling from the powers that be in Beijing to really explore options that weren't on the table, actually, as recently as 2 weeks back, to try and address some of the inventory issues in the housing market. Speaking of, by the way, a bit later on, we'll be getting something on Country Garden, of course, big week here as well. It comes down to, a lot of things here.
Well, Country Garden is interesting. They got 2 bonds, coupon payments that are due, I believe, on May 9th. These are yuan bonds. And they've been talking about, basically, these are some of the bonds that have been guaranteed by the state. So it's really putting things to the test, whether they can actually make those payments or not.
Yep, we'll see. Okay, is there enough cash to tell you about risk premium standing out? We'll talk more about this later on. Effectively, you're looking at earnings yield, less, of course, where you are in the benchmark rate. China standing out. That's the purple line on your screens. MSCI China. To be more specific here, we're coming off, in terms of just a macro story, Yvonne is pointing out, on Friday, the jobs report, of course, and really the biggest swing in U.S. Treasuries. So the Bloomberg Treasuries Index total return actually had the best week last week on the back of that massive drop in yields. And there we go as far as this conversation goes. I can't really see that clearly, but it was a dovish tilt. How many cuts are we talking now?
Two. So almost fully priced in, 2. And September seems to be back in play, according to what traders are looking at post this U.S. jobs report, because finally you're starting to see maybe monetary policy is reasserting itself in this labor market. And can the Fed actually move now if the job market cools and inflation still stays elevated? Some people like Citi, I think they're still thinking you don't need both of those things to come down for the Fed to cut now.
I think they think 100 from July, I think, is their
They still think a hard landing is a possible scenario.
Okay, let's see what other people think. Have a look.
This couldn't have been scripted better. This report runs the tables for a good report.
A Goldilocks report that will please the Fed and please the markets.
This is a good report across the board for validating what we heard from Jay Powell on Wednesday.
People were starting to be concerned that we needed more hawkishness from the Fed. We did not get it on Wednesday. We got a more muted version of what's going on. And I think that this data is starting to prove that out.
Now we're pricing in 2 cuts for the year. I think that's about right.
People were looking for a little bit of a slowdown because they don't want to have to think about rates staying high for much, much longer, and they don't want to think about a hike. They want to start thinking about easing. This puts that back on the table. You've already seen those odds go higher this morning.
I think the Fed would like to get a cut or 2 in this year, and today opened the door for them to get that done.
Let's bring in Gina Martin-Adams, our Bloomberg Intelligence Chief Equity Strategist. She's actually in the region this week. Gina, pleasure to see you in this time zone, of course. Get us warmed up for the week. And I want to start with earnings because that's really been the key focus in these markets. I think you have Disney out, Uber, and a couple of others this week as well. What's the thinking right now? What are you seeing as far as this earnings season is concerned?
Yeah, it's been a captivating earnings season, and while the macro has certainly been part of the backdrop for stocks, what's really driving equity sort of risk tolerance right now, in our view, is the earnings beat. So far this season, you've got about 80% of companies beating expectations. You've got earnings on pace to nearly double the growth rate expected at the start of the season. Certainly the Magnificent Seven are a huge part of that story. You also have a lot of announcements of buybacks and capital deployment really helping to fuel optimism in the equity market. So we look for a continuation of that next week. As we move into the bulk of earnings season not related to the Mag 7, can we continue to see this optimism really support stocks is the key question for this week. A couple of things that I'm looking for: revenue growth. Certainly we want to continue to see stable volume sales. That definitely complemented by decelerating prices, which deplete the margin pressure somewhat on the index, allowing for a little bit of float up in margin expectations going forward. I think those are the keys to really watch.
What about in terms of, and you touched on this a little bit already, the delta and revisions? Where are you seeing the best momentum there as far as changes to expectations and earnings?
Yeah. Now, this is so interesting because over the course of earnings season, the one thing really stands out with respect to the outlook, and that is broad upward revision momentum across the index. So analysts were caught a little bit too cautious coming into the earnings season. And I think that really reflects this over-captivation, if you will, with the macro climate, with the macro risks, which has really predominated index trends over the course of the last 2 years. Getting too caught up in the macro left you wrong-footed on earnings. And analysts markets over the course of the last several quarters have really played catch up on earnings realities. That's happening again this season. Estimate revision has been more positive this season than any point since September 2023. EPS revisions are positive and sales revisions are positive. And importantly, this is not about the Mag 7. This is actually value stocks that are driving the estimate revision upwards. So I think we want to watch that really carefully as more industrials, energy, materials companies, and even consumer companies report. Can they keep that momentum going over the next couple of weeks as we end the earnings season in the U.S.?
That's interesting. That maybe things are broadening out a little bit in this rally, Gina. So, do you think April was just a bit of a correction, a bit of a blip? You think that the rest of the year, the outlook for equities in the U.S. are a little bit more clear now?
Well, look, we came into April overbought to a certain degree. Pairwise correlations gave us a really good hint by the end of March that we were due for some form of correction. And then, of course, you got the volatility in the bond market affiliated with stickier than expected inflation, which now appears to be cooling. So those are the three things that I think you really want to watch. It's not really about earnings. There was nothing in April that suggested the earnings outlook turned at all. It was really about those indicators creating a little bit of friction or churn, if you will, in the equity market. So those are the things we watch. Pairwise correlations and the technicals have improved materially. We've certainly seen a bit of a cool down in stocks, allowing for a risk tolerance to potentially reemerge. The bond market has cooled down as well, with last week's payroll reports suggesting, hey, maybe the prospects for a hike are not in the cards, and maybe more neutral policy is likely in the short term, with potential cuts coming later this year. So as long as those things remain relatively calm and we keep getting the positive earnings cues, then it is pretty great conditions for risk-taking in equities right now.
That does seem to be the case. Gina, just a final question for you. I mean, here in the Asia Pacific, we're busy trying to figure out this Chinese market rally. We're just about entering the busy part of the earnings season here, and I'm wondering if you could compare and contrast what you're seeing in the U.S. Big picture. How do you as equities stack up relative to, say, Europe, EM ex-China, and China as well, Gina?
Yeah, I think that U.S. equities generally are in pretty good condition, but overbought to a certain degree. Certainly valuations are trading at an enormous premium. They're at a very different stage of their cycle than, say, China, which is just coming off of a lows, really celebrating policy inputs to the equity market, policy supports. So very different stage of cycle. I think that this is really important for the global equity investor, which almost got a little too complacent with the idea that all things move at once. That's definitely not the case anymore. We're a somewhat decoupled world, and we have to implement this decoupling in our investment strategy. When we're looking across the world, EM does show up. Emerging markets at large do show up as tremendously valued, with the potential for positive estimate revision, which with still steady PMI and economic signals. So it does show as a reasonably strong region for opportunity for the global equity investor. The U.S., I wouldn't count the U.S. out necessarily. It's just we've already had a year and a half rally. We're well into that recovery phase, moving into expansion phase now. Gains may get a little bit more difficult to come by in the U.S. It doesn't mean that you can't take risk, but you have to be a little bit more opportunistic and selective in the U.S. market, whereas China sits on the other end of the spectrum, incredibly oversold, policy supports coming in, really low expectations, set China up at a different stage of its cycle.
Gina, great to have you here in the region. Gina Martin-Adams, our Bloomberg Intelligence U.S. equity strategist there, joining us, of course, this week in Asia. Still ahead, we're going to take you exclusively to the BNP Paribas Global EV and Mobility Conference here in Hong Kong. Head of Global Automotive Research, Stuart Pearson, joins us later on this hour.
Yeah, but ahead of that, the President Xi Jinping, of course, is in France. He touched down, of course, kicking off a three-nation trip through Europe, designed to bolster ties even as trade tensions mount. The details and a preview of that trip just ahead here. Counting down to the Monday Open to reopen in Shanghai and Shenzhen, and of course we're coming off quite a eventful, weather-wise at least, weekend here in Hong Kong. 15 minutes away. You're watching The China Show. Good morning.
All right. right, first fix we've seen in a few sessions here, and there you go. It is a stronger one. We're sub 710 at 709.94. I think it's not a big surprise given the moves that we saw in the offshore rate last week, since we did actually breach that 720 level and hit 719 at one point. So therefore, you might see a bit of that catch up here today after that reopen from the holidays.
Yep, 13 minutes from now, the spots probably around 720, 719. Let's preview this big trip. Of course, the Chinese president, Xi Jinping, has arrived in France, three-nation trip through Europe, designed to bolster ties even as these trade tensions mount. Rebecca Chung-Wilkins, our Asia economy and government reporter, is with us here to talk us through the preview. Let's start, why not, in Paris and what the agenda looks like here.
Yeah, absolutely. I mean, France is here, the leading nation in the European Union among these three countries that she is going to visit. So a big part of this is trying to put a little bit more space between the EU position and the Washington position when it comes to all of these probes that we've seen into Beijing state subsidies. We actually know France was said to have backed that really key investigation that was launched last autumn into Chinese EVs. That was the sort of probe that seemed to start this sort of trickle and now this litany of other investigations into other forms of green tech. So that's a big item on the agenda for both of them. France, too, just recently has announced that it's trying to increase its amount of EV sales fourfold by 2027. So also making a very clear claim here to precisely its own agenda and its priority. But the other element between Xi Jinping and Emmanuel Macron is this personal touch. This belief on both sides, it seems, that they can charm one another through this personal connection. We have Macron, for example, inviting President Xi Jinping to this corner of the Pyrenees Mountains where he spent a lot of his childhood with his grandmother. That's a reciprocal gesture for Xi Jinping, who invited Macron during his visit to China to the Guangdong residence of the governor, which was a post held by Xi Jinping's father. So we see both this sort of feeling on both sides, the ability to court one another. It's hard to imagine another European leader doing something so personal with Xi.
So what can Xi do? I mean, obviously Macron's, bringing up the charm offensive. I mean, certainly, is he going to play hardball too, Xi, or do you think he's also going to be a bit of the charm offensive to try to, mend these ties right now?
I think what's really interesting with both Xi Jinping and also his number two, Premier Li Qiang, is what we've seen is this very forthright and much more engaged approach to when it comes to these issues of overcapacity and talking with Europe. We saw this during Scholz's visit to Beijing. Instead of the more sort of terse and brief responses that we've seen China give to US officials, for example, there was seen to be more deeper engagement. And so I think there is a perspective from Beijing that on the French side and perhaps other sympathetic European nations too, there is ability to really negotiate when it comes to explaining clearly what Beijing's point of view is here. Of course, they have said that there is no overcapacity, that actually these goods are not just good for climate change, but also really important in helping lower inflation and so on. So we have seen this quite sort of forthright and detailed pushback against these accusations of overcapacity. I think it speaks to a belief on Beijing's side that there is room to negotiate. There is room to have a discussion.
And, just ahead of this, France just laid out its clean energy ambitions. It's particularly with EVs, right? It's time to pack with the autos. And I'm wondering what role China could play for France to achieve those targets, for example.
Well, I think part of this is that is the big issue, which is what role is China going to play when it comes to the EVs, with France and other European unions saying you're playing too big a role and this is too much. We need to think about slowing it. We need to think about how to encourage our own homegrown industries. Right. But what we have seen, for example, is is China looking to open more factories in Europe for BYD, potentially opening in Hungary. Right. We see there's another deal potentially in Hungary. Recently, we saw Chery, the Chinese automaker, reusing or sort of reopening an old Nissan factory to open its own facilities. So with China going into these individual European countries and actually creating jobs, actually using factories that already are in process and operating to try and create more local economic growth, it's one way that sort of China showcases the the benefits of the economic ties. If they continue to keep these barriers, these trade barriers open, continue to allow Chinese EVs into that market, these are some of the benefits. We'll create jobs, we'll create local economic growth. That latter part of the trip with Serbia and Hungary, again, speaks to the benefits. The rewards clearly, as Beijing sees it, outweighs the risks when it comes to doing business with China.
Rebecca Chung-Wilkins, our Asia economy and government correspondent as well. We're taking a look at when it comes to pre-market in Hong Kong. It's flat right now, but we're talking about the longest winning streak we've seen since 2018 for Hong Kong stocks. Futures, though, when it comes to the onshore market, are certainly still quite positive here this morning. We're up about 0.1%. Plenty more ahead. This is Bloomberg.
Right, just approaching the opening bell here. So equity markets here in Hong Kong are slow to get out of bed, though can't blame them after being quick out of it really for 9 days now. 9 days of gains. We're looking ahead, of course, to the reopen onshore in the mainland, and of course that's where we're probably going to get this catch-up rally taking place.
Yep, and we're taking a look at, of course, some analyst actions for you. So we're watching the solar space, Lenovo, there's a call there. Xingde, H shares cut to reduce at HSBC. Fosun Pharma also raised to overweight at Morgan Stanley. They're saying the supportive policies and his confidence on companies' profitability step up that may drive investors to growth stocks here, and Lenovo raised to a buy at CLSA.
Yep, looking at Macau casinos, we have some data coming through. This is based on local reports here. 1.25 million visitors during this almost week-long holiday. All that being said, we're not seeing that play out. Although that said, of course, this group has also rallied substantially in recent days.
Citi says the city posted strong volumes during the Labor Day holidays, powered by player count and higher wagers, so maybe more bets being played there over that weekend. But yeah, as you mentioned, some of these stocks were already rallying ahead of that data as well. In terms of the property side of things, we're watching very closely what goes on, obviously, with what's been going on with Country Garden. So these 2 bond payments that are due. There's also these vows to study steps to digest the home stockpiles as well. So we're watching very closely. Seems like we're still seeing quite a bit across some of these property stocks, with the exception of Country Garden Services, which is down some 4% right now.
Yeah, an IPO possibly of an EV name that is backed by Geely. One to watch, of course. We're looking at quite a bit of an amount here. And, of course, Geely shares down about 8 cents at 1% in your pre-market. We'll talk more about this later. And, of course, this rally has taken up this market, 25, 30%. It's taken up 10 cents, 40%. And that's enough to make the company 10 cents back now within the top 20. This elite group of the 20 biggest companies in the world by market cap. We're back there. How long it lasts, we'll see. The open is next. Happy Monday. You're watching The China Show.
Welcome back. You're watching The China Show. We're kind of on the open of markets, of course, and that reopen in mainland markets here today after being shut for 3 days for a holiday. And certainly, just given the outperformance we saw in the Hang Seng last week, there's plenty of reasons that maybe this equity market can really gain, especially when it comes to not just stocks, but also the currency as well, Dave.
Yeah, you have 2 versions of one thing, right? So onshore and offshore rates, A&H shares. We're expecting quite a big dip at the open in dollar China. Of course, we'll get you that spot rate in a moment. CSI 300 was actually trading at 3,600 last I checked, so which would take that specific index, Yvonne, back to the highest level here since October. So we're now set to open at the highest since that point. We're looking at 15% gains now on price on the CSI 300 at these levels, taking it from the bottom. A quick glance at some of the small caps on your screen. CGBs, of course, that's a separate conversation to be had. Crude, of course, we're down 5%, and of course, over these last few days or so, we've seen some pressure come through in the global oil market. A glance at some of the biggest stocks onshore, Moutai, CATL, Ping An, of course, as you can see, and as expected, really, substantial gains there at the open, 1% on the Shanghai Composite here. Flip the boards. Let's have a look at Hong Kong. 9 days of gains. on the Hang Seng Index. We're opening flat right now. The PMIs came out about an hour back, 50.6. We're coming off a 50.9 reading on that specific benchmark as well. Glance at some of the big names, of course, here in Hong Kong, and we mentioned this earlier on in case you missed it. So 10 cent last week, because of that 40% rally, has now taken the stock back into the 20 biggest companies in the world by market cap. It's now number 20. 365 a pop right now for shares at 10 cent. Very quickly, a couple of movers we're looking at right now. So casinos, we're getting some numbers coming through on the sort of passenger flow and tourist flow into Macau. Some declines at the open there. Lenovo getting an upgrade. I think CLSA was the one that put out this call, and Geely Auto 1% lower here on the back of news or reports that one of its EV plays might be seeking a listing in the U.S. Okay, as promised, currency markets, dollar China, offshore and onshore rate. You had a big drop in the dollar last week. That's your offshore rate is the yellow one you see on your screen. So we're opening just at about that level right now. We're trading at 721. There we go. On the spot rate, we're trading at 721.09. So almost parity in both CNH, CNY as far as that's concerned. We had a fixing just below the 710 handle, of course, earlier on. I believe there's also some withdrawals out of the PBOC. But yeah, well, just a glance at this. And of course, Yvonne, we're looking at the equity markets and really to get a sense of flows, positioning, volumes, turnover, to get a sense really how much more upside, short term at least, this equity market rally has.
Yeah, who better to ask than Sunil Koul, APAC equity strategist at Goldman Sachs. Sunil, good morning to you. Where are we in this China rally now? You think we're nearing an end, or you think it could actually keep running?
Look, I mean, Yvonne, we think the rally can sustain for a bit. I mean, look, I think the moves have been pretty strong, as you know. I mean, from the bottom of April 16, I think MSCI China or HSCI is already up 14-15%. But if you go back since the Jan lows, you have seen more than 30% rally in the market. But we think it can sustain because, if you look at valuation positioning, that is still kind of pretty low. I think even with the 30% plus rally, valuations for MSCI China are still at 10 times forward, right? Which is still one of the most inexpensive market in the region. I think from all the positioning data we are tracking, it still seems that both hedge funds and the long onlys, the positioning is at 5-year lows, despite kind of the buying in the last few months. So I think those metrics still look pretty supportive. I was in US and Europe last couple of weeks seeing investors, and I would say there is still very strong interest from people in the recent weeks to increase allocations to China now. In fact, I think we are picking quite a bit of interest in upside ideas in China, both in terms of ETFs and upside call options. So this is sort of encouraging because it's different from some of the prior rallies we have seen in China, which were kind of much more driven by short covering. But this time around, it seems we have sort of genuine investor demand, both from long onlys as well as hedge funds. So we think the momentum could sustain.
I mean, perfect segue, Sunil. Talk to us about alpha opportunities this deep into maybe a rally, and where you think the money should be flowing into at this point, Sunil.
Yeah, look, I think in general, we do see pretty much across the region, we are sort of seeing China obviously is seeing inflows in the last few weeks. I mean, if you actually look at the hedge fund data, it's been 3-4 months in a row where China is being net bought by hedge funds. But as I said, allocations are still low. So I think money is moving clearly into China. If you look broadly across the region, some of the North Asian markets are also doing pretty well. I think there is obviously the broader value up program going on in Japan, going on in Korea. So I think those markets are also doing pretty well. Hang Seng obviously doing strong as well. So I would say I think India on the margin has been a bit softer and some allocations going out of that. But I think broadly speaking, I would say most of the North Asian markets, Korea, Japan, Taiwan as well, including China, that's where money is kind of flowing in at the moment. What we are also noticing is that if you look outside of the Asia, many of the China-centric markets or sensitive markets are actually doing pretty well in terms of flows and performance. You're seeing that in Aussie dollar, you're seeing that in Brazil, Chile, and some of the commodity heavy markets as well. So I would say those are the pockets where money is moving.
How are you looking at the earnings picture? Because we got kind of mixed reviews of how, less bad or, I mean, I'm just wondering in terms of downgrades, what are you looking at right now in this China equity market? And if we're still not seeing the fundamentals improve meaningfully, can this rally still continue?
I mean, that's a great question, Yvonne. I would say, look, I mean, to some extent, part of the rally was obviously driven by entire kind of policy easing around the 9 majors, but there was a bit of fundamentals to it as well. I mean, especially if you sort of looked at the 1Q data in terms of macro expectations, they were pretty strong. I mean, both we and Street actually raised our numbers in terms of the 1Q GDP expectations, right? The fourth quarter reporting season, which was undergoing until sort of last couple of weeks, they actually came in better than expected. The full year calendar 2023 earnings came in around 9% year on year, so it was sort of certainly better than what the market was anticipating. So I think both in terms of the macro numbers, in terms of GDP, but also I think the fourth quarter reporting season was strong. I think the early data from the first quarter reporting season we have seen is around sort of 30-40% in. And I would say the numbers have been a tad weaker, around sort of 2 to 3% down year on year. But at least what we are seeing is that there are select sectors where things are starting to see some upgrades. I think consumer tech, internet would be one pocket where at least the numbers are starting to get upgrade. I think it's still, we need still more evidence, but our sense is that if you see the first quarter numbers also holding up better, that could give some legs to the rally in terms of fundamentals improving. As you said, still the market is seeing in aggregate downgrades. So the year-to-date MSCI China has seen around 3% earnings cuts, but selectively there are pockets, as I said, which are starting to see upgrades. I think consumer and internet are the 2 pockets I would point to. But that's something
Sunil,
we're
I want to broaden out the conversation to the rest of the region, and I want to get a sense of where your head is as far as currency risk is concerned, and how dollar investors should be looking at, or the opposite really, how should be looking at managing currency given where you are in exchange rates. Dollar yen, we talked about that, dollar peso 58, dollar Indonesia 16,000. We can go on and on. Is that a risk to consider at this point or not?
Look, I mean, we saw some of that play out, right? I mean, there was the period wherein I think last few weeks, I would say sort of 3 to 4 weeks, wherein you had both kind of rate expectations getting priced out in terms of Fed, but also kind of commodity prices going higher, US 10-year increasing. And so that sort of dollar strength basically mean many of the EM currencies came under pressure. I think at this stage, we are at a stage wherein I think the bulk of those moves are behind us. I think we're sort of getting to a place where both the market and us are kind of baking in kind of 1 to 2 Fed cuts into the year. Having said that, I would say there was still, if you look across the region, there are markets that are kind of much more sensitive to US rates and dollar strengthening, and North Asian markets are sensitive somewhat. If you look at some of the South Asian currencies, India is a good example. I think one of the feedbacks we're hearing from investors is that in this entire dollar cycle, India used to be one of the currencies which used to be sort of considered more vulnerable, so 2013 taper tantrum, but the currency has been pretty stable. And part of that is to do with the fact that you've got very strong services exports and very strong FX reserves from RBI. So I would say within the EM or Asian markets in general, there are pockets which have been very resilient, and I would put sort of India in that bracket. And then there are kind of North Asian currencies which are obviously much more cyclical, but we think some of that is already priced in terms of how much the dollar has strengthened and how much sort of rates have moved, and how much currencies have moved. Some of that is already in the price.
Sunil, have a great week ahead, sir. Hi to the team for us, of course, there at Goldman in Singapore. Sunil Koul, APAC equity strategist at Goldman Sachs. Right, so we're about 9 minutes into the reopen here. CSI 300 up 2, even more than 2% last we checked here. 1.5%. There we go. My mistake. 2-3% as far as real estate stocks are concerned. That's playing a bit of catch up. 1668. That seems like a ticker. That looks like that is South City Holdings. Okay, there we go. 24% to the upside. Plenty more ahead. This is Bloomberg.
We're seeing a lot of our clients in the region and globally actually looking for some diversification in their counterparty relations. But that need for diversification we see a lot, and we're just gradually and gently expanding into that where we see opportunities to help them. They would like to see or like to have stronger relations with a European provider.
Some companies will not do as well as some others. So for the companies that do well, will remain very competitive in terms of cost control, in terms of product, function, quality, and value for money. What they will have to do is to adapt the changing environment. Consolidation pressure, price war, keep us on toes to keep doing a better job.
Just some of our guests this morning speaking to us exclusively at the BNP Paribas annual EV and Mobility Conference taking place here in the city. In fact, continuing our coverage of the event. Stephen Engel, our Chief North Asia correspondent, is there on the ground for us. Steve, take it away.
Yeah, Dave, our next guest is Stuart Pearson. He is the head of global automotive research at BNP Paribas, the host, of course, of this EV and Mobility Conference in Hong Kong, the second annual one. Thanks for having us. Let's talk about your latest research as well into the EV space. There's been a bit of an EV winter that starting to see, some clawing of success, at least here in Hong Kong. Some of the big EV makers, the prices are up since February. But where are we in that evolution of the downturn? And you're quite bullish compared to others.
Yeah, for sure. There's definitely been an EV slowdown over the last year or so, and we actually think we're approaching probably near the trough of that slowdown. Actually, when we look at the drivers of that, I mean, there's been subsidies removed in various markets, such as in Europe, but I think one of the biggest issues has really been some of the macroeconomic headwinds. In other words, higher interest rates impacting affordability. But we're starting to see that moderate, and actually we think you're starting to see an inflection and an acceleration in growth, which I think you'll see come through as soon as some of the April figures, and certainly into next year, we think driven by regulation in Europe, but also the huge cost compression that's going on, driving prices down.
Well, you're seeing the cost parity to the internal combustion engine cars starting to level out by 2028, is that?
Yeah, I think by 2028, and some car makers will get there sooner. When we look at across the whole value chain, from the battery cell makers, mining, up to EV assembly, all throughout this value chain, there's a huge amount of work going on to drive costs down, performance improvements, and that's really going to end up in much lower prices for the consumer, basically. So I think by 2027, 2028, we should be able to make certainly medium-range cars at the same price as ICE. And at that point, EVs should sell themselves. It's not about regulation.
So this is sort of an investor conference as well, and Hong Kong looks at where the investability is in this space. But a lot of these Chinese automakers, I was just at the Beijing Auto Show, they dominated the buzz, definitely, whether it's the Xiaomi SU7, BYD taking over the top spot over Tesla. But a lot of these, most of them, are not profitable. And there's a price war domestically that's driving things down. So where does the investor who looks at this space, looks at your bullish report and says, where do I get into the game?
Yeah, look, that's the difficult part, and that's what we're here at our conference to try and find out. And look, there is excess capacity throughout this value chain, right? From certainly from the mining side right up towards the forward side and EV assembly.
How bad is it? How much is it?
Well, on the battery cell side, you've probably got 40 to 50% oversupply. On the EV assembly side, probably 30 to 40%. But that part is growing pretty fast. And we talk about overcapacity in EVs, but there's huge overcapacity in ICE as well, and there always has been in the car industry. I think it's the direction that's important, and we think EV sales are going to quadruple by the time you get to 2030. So that overcapacity should dissipate over time, and actually we think the utilization of that capacity is going to be improving over the next few years. So in terms of where to invest, of course you have to tread carefully, and there's different companies in each stage of the value chain that can be attractive. But that forward side, some of the EV assemblers, we think you'll see some of those margins start to inflect positively pretty soon.
Is it going to be driven by these Chinese makers at the expense of the legacy automakers who have not kept up either on the autonomous driving space or in, the gadget-laden cars that the Chinese SU7 from Xiaomi and others have offered?
Look, I think it's undeniable the huge progress that China has made, and there's been a huge shift of gravity of the industry towards China. But I think the answer to that question depends on which region you're talking about, because certainly in the West, the brands do still count for something in the European and US markets, and of course it's not necessarily easy from a trade perspective to move cars around the world. So I think it's less about where you're from, but how you compete going forward.
So let's talk Europe, though. Then what's going to be the strategy for the Chinese makers if they're going to be faced with 20% 50% tariffs as is likely. Leapmotor just said, we've been planning for it. Yeah. It's going to happen. The U.S., it's a different ballgame. Probably not going to be allowing the Chinese makers to come in. But Europe, what do the legacy car makers have to do to fend off that competition?
Yeah, look, I think firstly, whether we have tariffs or not, ultimately the Chinese will need to produce in Europe to sell in Europe in the mass market. You know, mass cars don't travel globally that well because of the price point. So we will see local production from the Chinese, and at which point the cost advantage narrows a little bit because of the labour rates. But in the meantime, the incumbent car makers need to use that time to drive down their fixed costs and be very lean on their labour costs, on their R&D costs, reduce complexity, and also partner with others and think about where in the value chain do they want to compete. Do you want to be super vertically integrated like BYD, or do you want to work with the best in the industry to benefit from the best costs and best technology?
Yeah, because at the auto show, the Mercedes CEO, and they've had joint ventures, they pared back their joint venture with BYD in Denza down to 10%. They also have a partnership with Geely, but he was essentially saying, we're not looking at doing more joint ventures with actual car makers, but technology partners.
Yeah.
Is that the key there? Because the big buzz at the auto show was the SU7 from Xiaomi. Technology companies coming in and making a play.
I think it's looking about what is the gap in your skill set and your R&D processes as a company like Mercedes or any other Western firm, and who can help you plug that gap. So Mercedes doesn't need to learn anything probably about manufacturing its cars. It's not aiming to be a huge volume maker. So yes, it makes sense for them to team up with technology partners. For somebody else, so we're looking at Stellantis teaming up with Leapmotor, getting access to low-cost EV platform and manufacturing, then there's a different rationale. So I think it's a different strategy for different car makers.
So the big buzz last week as well was Elon Musk flying into Beijing, signing, basically getting approval for FSD, full self-driving, with his partner Baidu. Is that a game changer or a watershed moment? Who needs whom more? Obviously, Elon Musk and Tesla need China, but does China need FSD?
Yeah, look, that was clearly a positive development for Tesla because others were starting to get ahead of them in terms of self-driving capabilities that they're offering in China. So our view on that is I wouldn't call it a watershed moment, but I think it certainly helps Tesla catch up where the competition are. But Tesla really needs China. Obviously, it's the biggest car market in the world. They want to lead on full self-driving globally, and they weren't doing that in China. So this at least helps them close that gap to the peers, which was starting to open. But they still have a lot of work to do to really become a leader on that in the China market. Is Tesla in trouble in China? I wouldn't say Tesla's in trouble in China at all. They were still selling a huge amount of cars here. But they need to prove that they can catch up on the self-driving.
Stuart, Pearson, we can talk about cars all afternoon, all morning. But we're out of time. Thanks so much. Thanks for having us here at the conference.
Thank you for having me.
All right, Yvonne, back to you.
All right, we'll have more from the BNP Paribas EV and Mobility Conference later on. The next hour, we'll hear from Zongmu Technology on their business strategy as well.
Right, just some data that came through a couple of minutes back. So we're looking at the Taishin numbers. This is composite and also services numbers, both for April. 52.5, 52.5, if you want to be pedantic about this. The survey was also for that amount, and also composite coming in at 52.8. One was slightly better than the previous month, which was composite services coming down a little bit as well. These are, of course, sequential in nature, fairly. There we go. Plenty more ahead. This is Bloomberg.
Here's some of the stories we're tracking for you today. Bloomberg has learned that CICC is planning to demote some of its senior bankers and cut their pay. The unusual move could lead to voluntary departures from one of the country's largest investment banks. Sources say CICC has told staff internally that some individuals could lose their managing director titles and be relegated to lower ranks under a new performance rating system. HSBC's largest shareholder has voted, against keeping outgoing CEO Noel Quinn as a director, suggesting his campaign against the lender will continue. Ping An Insurance Group also lodged its protest vote during that HSBC shareholder meeting on Friday. Now, that's after Quinn announced plans to retire. Ping An has called for HSBC to spin off its Asia operations. That proposal was defeated during last year's AGM. Hon Hai's strong growth in April sales is helping to boost expectations for iPhone sales. The company, also known as Foxconn, assembles most of Apple's smartphones and posted a 19% jump in monthly sales from a year ago. Foxconn's revenue rose to a record for the month as it diversifies its business to focus on equipment tied to AI. And Qantas has agreed to pay a fine of 100 million Australian dollars and compensate customers over claims the airline sold tickets on thousands of flights it had already decided to cancel. The agreement was Australia's competition watchdog, also includes a remediation program expected to cost them $20 million. Payments to affected customers will range from about $225 to $450.
Yeah, shares of Qantas flat there over in Sydney. We're going the opposite way as far as onshore and offshore rates. So 1.3% CSI 300 to the upside. About 240 stocks on that, on the CSI 300, so 300. Are actually on the way up, so there's good breadth. Also, in terms of sector movers, most sectors are up, 7 out of the 10. This is interesting. So across the Stock Connects, which reopened today, already 12% of the daily quota on the northbound route. So you're seeing a lot of money come through heading north here, have been used up in the first 30 minutes of trade, which, of course, this has been closed, so you are getting some catch-up there playing up, too.
Yeah, it seems like there's that bit of profit-taking in Hong Kong and a bit across onshore here this morning. Coming up on the China Show, as President Xi starts his Europe visit, we'll be looking at what he's aiming to achieve and the challenges standing in his way. The President Emeritus at the European Chamber of Commerce in China is among those sharing his views. Plus, we'll be back live at the BNP Paribas Global EV and Mobility Conference with autonomous driving tech firm Zongmu. We'll have a lot more coming up in the next hour. You're watching The China Show. Welcome back to the China Show. Here's a look at the CSI 300 just a half hour into the session. And there you go. There's your catch-up trade here this morning, coming back from that 3-day holiday and really trying to match what we saw from Hong Kong last week. Mind you, that was about a 4% gain in 2 days on Thursday and Friday on the Hang Seng and H shares. So certainly there's still a bit more catching up to do. But you mentioned about the northbound flows have been quite substantial, Dave, so far.
Yeah, I mean, the first 30 minutes of trade, we're already seeing a drawdown of about 13. We're probably moving into 14% as we speak, which, by the way, we don't normally get, but, you know, we're not usually coming off, 3 days of holiday, but certainly want to note, right? So there has been money waiting on the sidelines to get back into onshore markets via the Stock Connect, and you're really seeing that play out more pronouncedly than usual at this point in time. Right, a couple of sectors onshore that are outperforming the broader benchmark in the early goings, first 30 minutes of trade. You're getting property names coming through. You had a massive week last week, of course, on the back of, expectations of policy and how the policy regime has shifted in favor of perhaps addressing some of the structural issues in the sector here. So you're getting CSI 300 Real Estate Index and also the Shanghai Property Index, which are obviously have overlapping constituents. Consumer staples up 3.1, 3.2%. So these are your Moutais of the world, some of the liquor makers, of course, and some of the hardware plays also playing out 2.4%. On the CSI 300. Right. Let's broadly speaking, though, it's by the way, we don't have trading in many markets in the region here. Many, I think 3: Thailand, Korea, and also Japan are shut today. Ex-Japan, they were up 0.7%. S&P futures are just hovering just above water right now. We're coming off a big drop in the U.S. dollar and also a big rally in Treasury markets last week. In fact, the biggest week for Treasuries on price so far this year. We're getting some weakness coming through in the 2s and the 10s so far. But broadly speaking, as you can see, it's generally risk on with most FX markets in favor, of course, or less in favor of the dollar, and a couple of markets coming online already. And Taiwan, I should also mention, when you look at that market, Honhai is up 6%. We'll talk more about that later. That's helping lift that specific index, Yvonne, up 1.5% in about first 60 minutes of trade.
Yeah, and we were just talking to Goldman's Sunil, Koul about this, right? That all the volatility in FX and that seems to be something in the past now that the market can kind of move away from, and they're starting to see signs of maybe even fundamentals looking pretty good, especially when it comes to China. Risk appetite is getting better after his trip to Europe and the U.S. as well. He talked a little bit more about the fund flow situation and how things are broadening out, not just for China, but even some of these China-sensitive sort of sectors as well.
There is still very strong interest from people in the recent weeks to increase allocations to China now. In fact, I think we are picking quite a bit of interest in upside ideas in China, both in terms of ETFs and upside call options. This is sort of encouraging because it's different from some of the prior rallies we have seen in China, which were kind of much more driven by short covering. But this time around, it seems we have sort of genuine investor demand, both from long onlys as well as hedge funds.
Our MLS strategist, Mary Nicola, joins us now from Singapore to talk us more about this rally. It seems like, from Goldman's perspective, we still see some more upside to go. What's your team looking at this morning?
Yeah, we were looking at the fact that we could see a tailwind, obviously, from such a stellar week in Hong Kong. So the expectation that, the onshore markets would follow suit, and so far the opening has been strong. And of course, there is some of the catalysts coming from the very positive Politburo meeting, where it released some of the announcements at the end of the Tuesday, after the Tuesday market close. So there is some upside. There's a tailwind from there as well that looks like it's going to support China equities.
Right. Now, one of the pieces you put out to get us started for this week, the rally, to your point, is getting very hard to ignore at this point in time. You've put certain metrics very much in focus in front of viewers right now and investors. We're looking at risk premium and why this market stands out. Why is this important? If you could give us a one-on-one as well, what we're looking at here, Mary.
Yeah, absolutely. So we know that China valuations have been cheap, right? But there's more to it than that. So there's this equity risk premium that we like to focus on, where you're looking at how much you're getting paid for taking risk. So essentially, what is the difference between the earnings yield from China equities, in this case we use the MSCI China, over the government bond yields? And that tells you roughly how much compensation you are taking for going into something risky like equities versus staying in something like government bond yields. And that's starting to look a little bit more attractive in China and stands out, especially against its regional peers. So that's something to keep in mind, that you are getting compensated for taking risk. Also earnings, as you mentioned earlier about Hunhai, there's some catalyst there and movement showing that earnings are moving in the right direction for China. So it's not just that it's cheap, but and arguably could be cheap for a reason, but there's also the fact that earnings are moving in the right direction and you're getting compensated for moving into equities versus staying into government bonds.
And it seems like, even if we go broader, the macro picture seems to have shifted a little bit more. The Fed's been leaning a little bit more dovish. You had that moderate sort of jobs report on Friday. I mean, is there a chance now that this everything rally can reignite itself again?
Yeah, so there's a bit more broader, even for China, where we had the services PMI. They're showing signs of stability. Same thing with the manufacturing PMI. All these are showing signs of stability from a macro perspective for China. But then when you look at the broader picture and what's happening in macro markets, so for example, the fact that Jay Powell pushed back on expectations of a hike or even going for a hike, we know that the next move is going to be a cut, even though inflation is a little bit sticky, but there's still a next move for a cut. And then, of course, the jobs report showing some cracks that are coming through into the system. Of course, it's only one data report, but it's showing that there's some cracks in the system where we could see that everything rally coming through and reigniting that vigor that was lost because of concerns about Fed hiking or Fed hikes being delayed. So they are still going to warrant patience, but now it's about the fact that hikes have been completely put off the agenda.
Yeah, Mary, just a quick note, I guess, as a final thought on that last note you mentioned here. We're looking at a softer dollar this week. How much does that help?
Yeah, the softer dollar, especially for Asian currencies, Asian risk assets, should be absolutely supportive. One of the things that has really brought down the region, obviously, has been the rise in U.S. Treasury yields, the strength of the dollar, the resilience of the dollar. That's obviously weighed on this region as a whole. So once you start seeing that the dollar is losing some of its steam, some of these currencies can start making up ground, and that, of course, includes the yen, where all eyes have been fixated on the yen, and especially in terms of how much that, that back and forth between traders and officials are going to continue in terms of whether it is a one-way bet, or is there's going to be some back and forth on the yen.
Mary Nicola in Singapore for us. Right, just ahead here and shows our deep dive into President Xi Jinping's Europe tour as trade tensions mount. We talk about that with the European Chamber of Commerce in China next. Stay tuned for that conversation. Happy Monday, by the way. This is Bloomberg.
Well, Chinese President Xi Jinping has arrived in France on a three-nation trip through Europe designed to try to at least bolster ties even as trade tensions do mount. We talked about just the significance of this, right? This is the first visit to the region in 5 years for the president, and Xi's tour comes as the EU forges a more unified voice with Washington in opposing China's capacity for cheap exports and perceived national security risks. Now, during his European leg, Xi Jinping aims to highlight some of these economic opportunities for the EU, maybe some opportunities for Chinese investment, certainly, and seeking France's support in encouraging the EU to adopt a more pragmatic approach. In return, the French President Emmanuel Macron also hopes Xi can facilitate peace efforts in the Ukraine war and address issues over Chinese investments in France's EV battery sector. So a lot on the agenda, Dave.
A lot, yeah, and of course France, and then the president, of course, moves to Hungary and, of course, a non-EU member, Serbia, to really delve deeper into all of this, the significance of this. Of course, there's a sort of nuance per place and the big picture, geopolitically speaking. We're joined right now by Jörg Wutke, President Emeritus at the European Chamber of Commerce in China, and also joining us too is Warwick Powell, adjunct professor at the Queensland University of Technology. Jörg, let me start with you. You've been on the ground, of course, in many years from China, and just perfect person to really set this up for us. Initially, my thought when I heard the news was, why France and not Germany? But maybe you could answer the significance of that. Why France?
Well, first of all, we had Chancellor Scholz in China just about 2 weeks ago, so it doesn't really make sense that Scholz and Xi Jinping meet again. 2 weeks, nothing really happened. As a matter of fact, the Scholz visit was not really very fruitful. So it really makes sense to look up the biggest other nation in Europe, which is France, and Macron plays it quite well. He has invited EU Commission President von der Leyen to join him. And so it's a good sequence. And of course, then he moves on into Serbia to the anniversary of the bombing of the Chinese embassy in Belgrade in 1999, and then, of course, to the closest friend they have in the European Union, which is Hungary. So it's quite a very symbolic visit.
Warwick, chime in here. I mean, do you think there's anything that the Chinese president can do to avoid its relationship with Europe to deteriorate the way that it has with the U.S.?
Well, China just needs to put its own best foot forward. China will advance its own interests and its own perspectives on what is in the mutual interests of all concerned, and ultimately it'll be up to other parties as to how they respond to that. China has made it very clear for a long time that it seeks win-win cooperative relationships with other countries, and certainly I don't think fundamentally there are any conflicts of interest between these countries. So the objective material foundations for solid relationships are there. It's just a question of whether psychologically and emotionally the Europeans and the transatlantic powers are able to come to the party of a changing multipolar world.
Yeah, and Warwick, just to follow up on that, I mean, these meetings are taking place not in a vacuum, and certainly a lot of geopolitical events. Of course, you have the war in Ukraine, what's taking place, of course, between Hamas and Israel. It's an election year in the U.S., and I'm wondering, Warwick, what role does each one play or give the other as far as their geopolitical strategy is concerned? So what does France offer China and vice versa?
Yeah, I think it's important to take half a step back and probably not look at these issues so much in transactional terms, but look at them in broad historical transitional terms. And what's going on is that globally the epicenter of economic power, if you will, and economic growth is shifting towards Asia, and it's concentrating in Asia. And the European and transatlantic countries in general need to adapt to that changing environment. Now, in terms of the conflicts, in some ways, they're symptomatic of a changing global order, and they're symptomatic because we're starting to see the traditional powers fighting tooth and nail to hold on to what they think they've got.
You've worked in China for decades. You've worked in the auto industry, so you know what's really happening on the ground. Is there a growing sense of frustration now of these concerns about China's overcapacity and exporting too aggressively? Or is there still some sentiment out there that still thinks that China is a market of plenty of opportunities?
Well, first of all, I guess Scholz has mentioned this, Macron will mention it, as Janet Yellen said so in Guangzhou. China has huge overcapacity problems, which of course are challenging its trading partners, not just Europe and the US, but also, of course, Brazil and other countries. But China lives in denial and says there is no overcapacity, so she just has to bear this and listen to it all over again. I think that also she has to realize that Europe is basically using the new toolbox they built up. There has been new anti-dumping cases. There has been a subsidy case going on EVs, which possibly will come to conclusion in June already. And then you have also procurement. They more or less killed the Chinese bid in Bulgarian trade. So China has to realize that Europe has its own policy, its own trade policy, and will actually use its new toolbox. So the time of good words and warm words is over. China has to do something about more opening up in order to balance the kind of trade that we wish we would have with China.
Warwick, let me get your thoughts on the same topic. I know you have some views here on whether or not there is overcapacity, whether or not it's a relevant topic to a conversation to be had. Just give us your thoughts there, Warwick.
The idea of overcapacity is a furphy. It's raised largely by countries with incumbent industries that have failed to adapt to technological change, and they're obviously facing competition. The fact is that trading nations around the world have undercapacity and overcapacity in different areas, depending on what they're capable of and what they're good at. The fact of the matter is that the European Union needs to find ways to adapt to the changing technological and market landscape. And one of the ways in which it can actually do that is to welcome foreign investment to build up its own productive capacity so that it can be competitive.
What about EU tariffs on Chinese exports? Is that a real risk now? How close are we really when it comes to a possible trade war between the EU and China now?
We are not very far away, and overcapacity is an issue as China produces 2.5 times global demand in solar panels, for example. China can produce 50 million cars. It itself consumes 23 million. Actually, what I was also telling Janet Yellen in Guangzhou is that overcapacity is already a huge problem within China because everybody produces stuff and nobody makes money. And Europe is the last big market open for cars and for other items, and China should be very interested to actually maintain that. Trade imbalance is at an all-time high. We had 3 years ago 3.4 ships, containers going to Europe and only one came back. This year we will face 4 to 1. China is indeed an export powerhouse, but it has to realize that Europe is not going to stay open forever.
Yeah, and the other side. The other side to that same coin is, the lack of FDI into China in recent years, or the drop-off we've seen from trend. Do you think that is a function of overcapacity in sectors that were actually magnets for FDI? And if you think so as well, what opportunities do you see for foreign capital to play a part in Chinese? Which sectors do you see the most runway, Jörg?
Well, first of all, in the equity side, as I said, nobody makes money, or very few companies make money. Actually, China, in many ways, is non-investable. The market has been underperforming quite a bit. But in the real economy, China remains extremely interesting. In the car industry, you see European, in particular German companies, pouring billions into this economy still. The chemical industry is pouring billions into this economy. So when it comes to real investment into concrete and steel, Europe is not letting go. Actually, they are doing more in order to actually catch up with China. And as Warwick was saying, we actually in Europe are very keen to have Chinese investors putting up shop in Europe. CATL has 2 plants, one already running in East Germany, one is building in Hungary. We want BYD to operate there. So unlike in the US, Europe is very keen in order to have the Chinese investors actually helping us to bridge the gap, because in many ways the Chinese have gone already much more ahead of us, particularly in the car industry.
So, Warwick, from the China perspective, is there any sort of room for concessions in this trip? And is it more going to be on the trade side? Or what about the strategic partnership with Russia? Is there any sort of leeway there either?
Look, on the trade side, I think the objective is to maintain open trade, and open trade will drive the allocation of capital, hopefully with the ability for new capabilities to augment European production systems. I mean, over the last 10 to 15 years, European production systems have, in terms of some of these new areas, the new energy areas, have fallen behind. Having said that, European car manufacturers continue to export substantially into markets like China, particularly in the internal combustion engine space. So, we haven't heard a lot of complaints about overcapacity in European manufacturers for the last 15 years. So, let's be fair about this. What we're witnessing at the moment is just transformation, industrial transformation that requires upskilling and the adoption of new technologies and know-how. And by working together, there's actually a much better chance of achieving that and achieving the investment and trade flows that deliver better living standards for people all across the Eurasian continent.
Warwick, just if you could elaborate on that, that's an important point, I believe. Well, let me rephrase it simply. Do you think the Chinese are coming into this conversation from a from a position of expertise in bringing in that technology? And Jörg, I want you to respond to that just after that. But yeah, go ahead, Warwick.
Well, certainly in some of the areas that have been identified as of particular concern, it's incumbent industries in the traditional markets that have fallen behind, and yet that is the direction of the world. Green development, decarbonisation, new energy technologies, whether it's in transportation or energy storage or energy generation, are going to be critical to achieving the climate change objectives that pretty much all nations have agreed to. Now, if we're serious about those transitions, then the least cost, fastest way is the way that people should be going. And if we can do that, it'll actually catalyse downstream industrial development opportunities, taking advantage of lower cost, cleaner energies.
Yeah, your thoughts on that, and also how does Macron sell that domestically, that the Chinese are coming in with good stuff?
Yeah. Well, first of all, China has 60% of global manufacturing capacity. They are standing for 31% of global manufacturing added value. So virtually every third product worldwide being produced is made in China. But China stands for only 14% of global consumption. So there's a serious mismatch in what they push into the international markets and actually what they consume. And that will be mentioned by Macron clearly. And the fact of that is we have 126 car companies in China, which already China finds not sustainable. So something has to give, and China has to actually let market forces reign. Companies have to go bankrupt there in order to get off the market, in order to also let the top players get a little bit of more price margins. And that's going to be very, very difficult in the process, but it has to be done also for the sake of the Chinese domestic economy. And let's see if Xi Jinping is listening or if he remains to live in denial on overcapacity when he leaves France.
Maybe a last question now. If Donald Trump returns to office, does it change the game in any way, the relationship between the EU and China?
I don't think so. I mean, we had Trump 1, and we both suffered tremendously from the Trump administration. We had a trade war, we Europeans with the US, and China didn't give us anything. I don't think that actually China took advantage of that. In many ways, I think, yes, we're both in the doldrums if Trump gets elected, and Lighthizer is going to implement what he has been outlining in his book, which is interesting to read. There's no free trade. Chapter 11 is all about what he will do to China, and he has also reserved a chapter for Europe. So we're going to be in a hot spot together, but I think there will be no alliance building between Europe and China in that circumstances.
Warwick, final thoughts. If it's a Trump 2.0, how does this change things or not?
Well, I think one of the problems is that it's largely anticipated to be somewhat unpredictable and rocky. So it is a little bit hard to put on the crystal ball and see clearly into the future. But let me just say one thing about this question of capacity, because I don't think that the description has been accurate. Chinese manufactured outputs have grown substantially over the last 30 years, but the fact of the matter is that 87% of outputs are consumed by the domestic economy, 13% are exported. So this idea of overcapacity is actually an absolute nonsense. There is exports, of course, but the majority of Chinese manufactures, including the growth across all sectors, has been consumed by domestic industry and domestic households.
Yeah, as you say, there's a bit of an undercapacity issue, according to Warwick. Warwick, it's great to have you. Thank you so much. And you're Warwick, President Emeritus at European Chamber of Commerce in China, and Warwick Powell, Adjunct Professor at Queensland University of Technology. Markets are looking like this year. Of course, we've been tracking what's been going on Shanghai, and certainly that return from the holidays has been looking very good, and we're watching very closely these chip sales as well. You take a look at Hanhai. So revenue was up 19%. It wasn't just the iPhone story, which was there were some wobbles and concerns there, but really about AI servers and really how they pivoted to tap into that sort of demand here. So Goldman Sachs is saying it's really second quarter is looking pretty good given just that AI prospects there. So up some 6%. That's really lifting some of these tech names here this morning. TSMC also up close to 2%, I should say, in Taipei.
Yep, we're looking at some of these tourism-related stocks as well. There we go. Tourism holdings, to be more specific there. We're up 37%. We're down the most, and this is down to good old-fashioned, plain vanilla guidance, disappointing markets. We're down 38% on that specific stock. MSCI China on your screens coming up as well in terms of sector groups. So just about every single sector is up. You're getting some weakness coming through, and I think the nuance here is really there's an interesting overlap between constituents because you are getting one part of this market catching up and doing very well, and one part, of course, that has been doing very well 9 straight days now in the Hang Seng Index going into today, so we could be snapping that. But as you can see, property leading this 2.3% to the upside. About an hour into the session, you're watching The China Show. All right, welcome back. Happy Monday. And finally...
some sun.
Yeah, some vision. You can see something after what was really a bit of a crazy... Was it Saturday?
Yeah, there was a red rainstorm on Saturday.
Yeah, I could barely see anything, do anything at that. 1.5% to the upside onshore. The market is reopening today. Of course, we're flat on the Hang Seng Index. Just to look at some of the sector groups as well there. So things like property leading the gains onshore, to be more specific, and you're looking at things like consumer staples, so liquor makers. But here in Hong Kong, mostly some weakness coming through as well.
Yep, we're following a scoop here this morning. Bloomberg has learned that CICC is demoting some senior bankers and cutting their pay in an unusual move to reduce costs. Look at the details now from our reporter, Pei Li. Really, why are they doing this?
Thank you for having me this morning. It's very basic. You know, it's very simple. The thinking that if I give demotions to some of the underperforming bankers, it's going to prompt some voluntary departures. Right? I mean, it's quite difficult, more difficult than in Hong Kong to lay off some of the people, and this is a smart way to them to make some of to let some of the people leave without making them redundant, which will result in very hefty fees and severance packages.
Right, and this is broadly part of a cost-cutting drive, isn't it?
Right. Yeah. Exactly. As we have seen in Hong Kong and also mainland China, a big chunk of the business is IPO, right? And that has been that's been down quite drastically. So deals making is volume is down, and over the years, because of the when the time was booming, they overhired a lot of people. So now CICC is apparently the biggest investment bank in China that hired more than 2,000 bankers across the country, right? So this new scheme actually would help them to rate those 10% of the bankers as like really underperforming, and they will see their title to be demoted. For example, if you're a managing director, there is 10% of them will be demoted to executive director, and then there is another 20% of the bankers, those regarded as underperforming, they will see a small demotion, which means, for example, if you're associate 2, you'll be demoted to associate 1.
Wow. Yeah. I mean, just talk a little bit more about CICC specifically. So, I mean, this was once a bank that paid as much as Goldman does. But then they've also had to scale back this whole hedonistic lifestyle. So we kind of saw this coming maybe before, too.
Right. Yeah. At one point, I think CICC is really considered as the Goldman Sachs of China, right?
Yeah.
Like the bankers, they hire a lot of bankers all across China. They're on every deal, pretty much. Not every deal, but a lot of those deals, you see CICC on them, right? And they're also like the worst hit bank in the past few years, right? I mean, not only deal-making wise, but also politically. I think some of the bankers, especially those junior banks, make some they post some flashy lifestyle on the social media, right?
Yeah.
And then got criticized on social media, became like a huge hit, and then the regulator, I think Beijing was unhappy about it, and then pounded the bank, and some of the bankers say, hey, you guys should really stop, the hedonistic lifestyle, right?
Yeah.
And also, get rid of the image of the so-called financial elitism, right? So, if you're a young kid, young graduate, you graduate really well, graduate from Tsinghua or Beida, and then you go to finance, work at CICC. That's you should really not take that for granted, right?
Yeah, that's a blessing and an opportunity, isn't it? There we go.
Right.
Haley, thank you so much. Our Bloomberg reporter there. One of our top read stories, of course, China CICC demoting senior bankers and cutting their pay to slash their costs. Very briefly, we're looking at markets still. Treasury futures, we're coming off a really, really good week, by the way. Last week, Thursday and Friday in particular, following the data points that came through in the U.S. So the biggest rally on a weekly basis for U.S. Treasuries this year so far. Some weakness coming through. By the way, you have no cash Treasuries today because Japan is shut, so you're looking at futures and the futures curve on your screens. Dollar is on balance weaker, although you are getting some currencies pushing the benchmark up a little bit. For example, dollar yen, as you can see, we're back to just sort of the weaker side of 153.50, and dollar China 722. Right, on the Fed conversation, so you have Chicago Fed President Austan Goolsbee says that the latest jobs report in the U.S. Is actually giving them comfort that the economy is not overheating. But when it comes to possible rate cuts this year, he says he still really needs to see more data confirming that inflation is headed under control.
175,000 is a very solid report. Some of the root of our frictions here might be there's a kind of a day trader's timetable and there's an economic timetable. For setting monetary policy, of course, you got to take a longer arc view on inflation, on employment, and we're just trying to figure out, after the excellent dual mandate performance of 2023, let's call it, where inflation fell almost as much as it has fallen on record, and did so without a recession, how much can we continue that into 2024? We hit a bump for sure at the start of the year on the inflation front, and now everybody's just got to take a step back and try to figure out, is that a sign that the economy's overheating, or is that a sign of some other thing? The more jobs reports you get like this, where they're solid, but it's clearly moving back into something that looks like pre-COVID and conventional times, the more confident we can be that the economy's not overheating. But we just gotta watch this.
You are one of the I don't want to use the word dovish, but more optimistic people about the possibility that rates could be cut this year. How do you feel now? We do see this slowdown. The ISM numbers show slowdowns. Spending numbers were lower than anticipated and lower than in the last quarter. Are we setting up to go back to the idea that rate cuts are going to happen this year?
I don't like committing, tying our hands of, even for the next meeting, much less when it comes to the fall and going into next year. I will say I was optimistic in 2023 that we could hit what I was calling the golden path, that there were reasons why, in an unprecedented way, we potentially could get inflation down significantly without having a big recession, which previous to 2023, that really doesn't happen. We did that in 23. As we're looking in 24, like I said, we clearly hit a bump at the start of this year, and we've just got to get comfort that it's not a sign of a re-acceleration of the economy.
And that was the Chicago Fed President Austan Goolsbee speaking with our colleague Mike McKee. And take a look at really the big events to watch this week. And that Fed pricing, repricing is certainly one thing we're watching very closely as well, right? Because after that jobs report, you basically are seeing that this is a market that is inching more towards 2 rate cuts, or at least full 2 rate cuts this year, versus the one that was priced in just last week. So certainly September is back into play. That's when we're looking at maybe as when we could see the first cut this year. The week ahead's interesting, right? Because you got the RBA and you got the BOE as well, following what we heard from the Fed last week. So the RBA is certainly one interesting one to watch, right? Given that the first quarter CPI numbers were pretty strong. Are we likely to see a bit of, I guess, hawkishness from the RBA this time around? It's more about hikes, I think, or at least the possibility of ruling them out than really the prospects of rate cuts right now. Yes, I think most economists think that they're going to hold. But interestingly enough, to your point, Yvonne, because of hot inflation, there's one economist who will go unnamed, it's just on my data point here, that actually thinks the RBA moves higher this week. So cash rate, in case you're curious, 4.35% is where we are. Of course, Bank of England, as Yvonne is pointing out, of course, that's Thursday. Among other things, of course, on deck, as you can see there on your screen. So Thursday is looking particularly busy. So I guess if either you or me are thinking of a day off or calling in sick. Don't take it. Or that's probably it. We're kidding. We're kidding. Okay. Anyway, plenty more ahead. This is Bloomberg. Happy Monday.
I think one of the biggest issues has really been some of the macroeconomic headwinds, in other words, higher interest rates impacting affordability. But we're starting to see that moderate, and actually we think you're starting to see an inflection and an acceleration in growth, which I think you'll see come through as soon as some of the April figures, and certainly into next year, we think driven by regulation in Europe, but also the huge cost compression that's going on.
We know the world's focused on AI. It's natural. It's been a very strong performing sector. But here at BNP, our researchers truly believe that there are some incredible opportunities in the EV space. But that need for diversification, we see a lot, and we're just gradually and gently expanding into that where we see opportunities to help them. They would like to see or like to have stronger relations with a European provider.
Some companies will not do as well as some others. So for the companies that do well, will remain very competitive in terms of cost control, in terms of product, function, quality, and value for money. What they will have to do is to adapt the changing environment. Consolidation pressure, price war, keep us on toes to keep doing a better job.
Some of our exclusive guests from the BNP Paribas EV and Mobility Conference now underway in Hong Kong. And continuing our exclusive coverage of the conference, let's get back to our very own Stephen Ingles, who's on the ground there. Steve.
Yes, our next guest is Ray Tang, or Ray as he likes to be called, founder and CEO of Zongmu Technology. He joins us right now. You're an autonomous driving company, but you do a lot of things with advanced assisted driving as well, ADAS. Tell me, where are you right now in the evolution of the EV space? We were, and you were there as well, at the Beijing Auto Show. There's lots of new technology and a lot of capacity in the EV space, a lot of great, funky new technology loaded into these cars. But how far away are we from full autonomous driving? That's a key part of your business.
I think that we are witnessing a lot of progress in the space, for sure, right? A lot of OEMs are now launching into new products, with featuring that what they call it, NGP or highway and city navigation guided pilot type of project. Definitely, it's exciting, and then customers are getting more and more, this kind of features equipped in their new cars. So at Zongmu, we are working very actively along with OEMs, that especially some of our key customers, to improve their equipment rate or attach rate for our products. We are doing both level 2 plus ADAS, and also especially in the parking space, we have a lot of advanced features for parking technologies. And in the meantime, we are also thinking that even though we are getting a lot of exciting features on the highway and city, it is still maybe, I would say, taking a little bit more time to evolve from today's level 2 to beyond level 2, because on open road, it is hard to get across that level 2 to level 3 barrier due to both technical and non-technical issues.
And there are environmental hazards that cannot necessarily be accounted for. When you get up to level 3 and level 4 or beyond, there's a safety issue, there's liability issues.
Exactly. So that's why that within Zongmu that we have a vision that we believe that level 4 could potentially first happen into closed compound, because in this closed compound, you have, basically your driving speed is lower, and so you don't have, fatal accident there. In the meantime, that you're already pretty much arriving the final destination within a walking distance. So the driver want to get relieved from the car. So we have been keep pushing for level 4 massive production, first in the closed compound. So we are working with some of our OEM customers on that. And in the meantime, we are also launching a new exciting business to deploy what we have developed for level 4 autonomous driving in closed compound into an energy robot as well. So that you can, once you go into that closed compound, you drive into that park, you can just, we call it drop and go. You drop off, go away, and then the car can pass off, and then our energy robot that we are going to launch will help to do
I think we have video of it, hopefully we do, of your new mobile charging robots that go around, and that is something you're launching right now, actually, right? But how competitive is the autonomous driving space in China? There's so much was made last week when Elon Musk flew in and signed the deal with Baidu, essentially, to develop or to bring FSD, full self-driving, to China. So you have that competitor, but then NIO, XPeng, Huawei, everyone else is also doing what you're doing. So there might be consolidation coming, continued consolidation in the EVs, in the units, but how about in your autonomous driving space?
Let me put it this way, autonomous driving, definitely you see a lot of buzz, a lot of big giant guys are trying to push, beyond, what you see and feel on the road. But if you do a reality check, the overall attach rate in the overall, market space is still relatively new, and it's only right now happening on the high-end premium cars as of today. And people are trying to drive it down, but then the cost of this technology is huge. So we have, in a certain way, that our own strategy to compete in this current situation is that we are working with our OEM customers and then help them to improve their attach rate. But we are focusing on closed compound parking and then helping them to build their own capability into high level, autonomous driving. But in the meantime, we are focusing on becoming an ecosystem partner for them in a closed compound.
And I guess you're kind of legacy car maker agnostic. You'll sell your system to whomever it suits, right?
Yes.
But you do have your key cornerstone investors, like Chang'an, as well as Xiaomi.
Yeah.
Now, Xiaomi had a lot of buzz at the auto show launching their SU7. They kind of loaded with technology, and I hear by August they're going to have autonomous driving capabilities. Have you signed a deal with your main cornerstone investor?
Well, both are very important, investors, and then they have been supporting us a lot. And then, like I said, for Chang'an, we are basically working with them on their next, platform, product, so that essentially we think that a lot of new Chang'an cars will be equipped with our unified driving or parking system, rolling out very soon, starting from the middle of this year. Their next platform, we expect to see a lot of, installation. As regarding to Xiaomi, I think that we've been constantly discussing. Their first one right now is, is an in-house design, but then moving forward in their future, models, we've been, we want to work with them. Yeah.
I have to ask you, I know we're running out of time, but we hear that you have filed for an IPO here in Hong Kong in March. When do you see that possibly happening? And how much do you need to raise?
I'm sorry.
An IPO, a listing here in Hong Kong.
Yeah.
Is it going to happen?
Well, I can't talk too much about that because this is, supposed to be a non-talking topic.
Okay, you're not supposed to, but the speculation's out there. But again, you talked about the need for a lot of cost for R&D. It's an expensive process.
It is. Everybody is doing that.
Okay, Thanks so much. I appreciate your time, and we'll be looking forward to hearing more from Zongmu. Okay. Thanks so much, Ray. All right, back to you guys. More from the BNP EV and Mobility Conference here.
Yep, absolutely. We almost got some news there. Almost. Not quite at that point. Okay, as Steve was just pointing out, we have more coming up there out of the forum. Of course, we'll be speaking with the head of the Mahindra's Automotive division, of course, exclusively, I should also note. There we go. At those times on your screen, so that's in about 40 minutes or so. Plenty more ahead. This is Bloomberg. You're watching the China Show. Some top global stories we're tracking at this point. Panama's ex-security minister, Jose Raul Mulino, has been declared the winner of the country's presidential elections. Now, Mulino was the stand-in candidate for disqualified ex-president Ricardo Martinelli. And Mulino will take office in July. That's after pledging to revive Panama's once stellar economy, now crack down on drug cartels, and also shut down migration routes into the United States. Now, Israel has closed a humanitarian crossing into Gaza after a rocket attack by Hamas. Israel's military says 3 of its soldiers were killed and 3 others were seriously injured. The armed wing of Hamas claimed responsibility for the attack from Kerem Shalom. It came as weekend talks in Egypt on a potential truce ended inconclusively.
And turning to the China Brief now, look at what's making headlines in national newspapers. And not surprisingly, there's been growing coverage of President Xi's visit to France in Chinese state media. Xinhua quoted Xi as saying he hopes China and France will light up their way forward with a torch of history for a brighter future. Meanwhile, the China Daily says Xi's visit will solidify robust ties while better managing differences. So the Global Times also ran an interesting editorial touting how China and France could complement each other economically. They highlighted Beijing's competitive advance in sectors such as manufacturing and electronics, while noting France excels in industries including aerospace and nuclear energy. The piece says that provides both countries with trade and investment opportunities. So there's a bit of a glow in how they're really covering this right now.
The areas of cooperation.
Yeah.
But no doubt, certainly EVs will still be the sticking point, right? So there are areas where they can complement each other, but certainly EVs and the tariffs that we were having a conversation earlier will dominate. We'll see what happens with that story. Now, over in Chinese financial papers, the Shanghai Securities News citing several analysts who are bullish on these markets and on these stocks, saying the major benchmarks are set to rise even further this month after hitting their year-to-date highs in April. Now, that's actually due to factors including some upbeat data on the economy and also looser monetary policies overseas. Now, the China Securities Journal, meanwhile, is reporting that more A-share firms have set or are set for delistings as policymakers strengthen oversight of zombie companies and bad actors in this market. The report estimates at least 24 will be delisted this year, redirecting resources to higher quality businesses. Speaking of markets, we're better off by 1.6% at 36,661. That should take us back to the highest levels here in the CSI 300 going back to about October of last year. So that's about a 6-month high. High-speed railway in focus. There's a plan on hiking tariffs there on price hikes. So we're looking at ticket prices will be adjusted effective June 15th. And you're seeing some of these, well, some of the companies in that ecosystem rallying substantially. Right. On to property, and one of the certainly sectors that are enjoying the tailwinds of policy and news flow. And as you can see, substantial gains still. And by the way, these are some of the big gains are actually in Hong Kong, which have been rallying so far. You are getting those movement onshore, like China Fortune Land, which is up 3.3% in that market. And also liquor stocks in focus. I can't seem to figure out why, but maybe on the back of spending, who knows? But this is really one of the outperformers today here.
Yeah. I mean, does it have anything to do with... I'm just speculating.
Festivities?
She in France, maybe? I don't know. I mean, there's all let's talk about what this means, you know, if there's this probe on cognac and...
That's true. There is that
I don't know.
conversation.
There might be something booze related in this trip as well.
Yeah.
We take a look at when it comes to your benchmarks here this morning. So onshore continue to see that catch up here this morning, and Hong Kong taking a bit of a step back. In fact, at least we're flat now in the Hang Seng. So we're paring back some of the initial losses here, but we're seeing gains of 1.6% or more on your Shanghai Composite NCSI 300, I should say, right now. Shanghai Composite is up some 1%. Small caps are also catching a bid here this morning, and dollar China, I'm watching very closely what goes on the onshore rate here. Continue to see those gains and that catch up in the currency as well. That's it for us here in the China Show. Bloomberg Markets Asia is next. Stay with us.